This video is about 4 ways to trade with support and resistance, and it's the latest in our series of tutorials on technical analysis. We're going to look at 2 basic approaches, and then for each of these approaches there's 2 different methods, so for a total of 4 different ways to trade with support and resistance. So do keep watching to the end of the video so you don't miss out on any of the 4. Hello, I'm Peter Martin with Trading 212, and we add educational videos about trading the financial markets to YouTube on a regular basis. If you haven't already, then make sure you subscribe to our YouTube channel by clicking on the red subscribe button, because that's just the easiest way to find out whenever we've added a new video. Well, let's jump straight in and look at, first of all, these 2 basic approaches to trading with support and resistance. Here is a diagram representing a price chart showing a market that is, or rather has been, in a sideways channel thus far. And we can see that over the period of time shown, the resistance and support levels have held. When the price has risen up to resistance, it has tended to move back down. And when it's dropped to the support level, it has tended to bounce. Now we can see that the price has, at this latest point here, returned to that resistance level that has been established previously. So as always, when it comes to trading the financial markets, we are now dealing with uncertainty. The resistance will either hold or it won't. Pretty obvious thing to say, pretty much a truism, but that is what makes support and resistance levels so interesting, so crucial to trading. It's that no matter whichever view you hold, whether you think the resistance will hold and the price will move back down, or it won't hold and price will carry on moving higher, it's when the market gets to this level now, i.e. actually about to test a previous support or resistance level, that you're going to be paying the most attention to see whether it does hold or not. And this makes it a kind of battleground level. Now let's say that the price actually just kind of peeps above this resistance level a little bit. You could take one of 2 most basic approaches. You could trade it with a view that the resistance is likely to hold despite being tested, and try and profit from trading that way. That is, selling to try and profit from this movement. Or taking a view that this peep above the resistance that we have here might be the first part of an actual breakout, of a new trend forming, and then trade accordingly, i.e. to buy to profit from that movement. So 2 basic approaches. And those 2 basic approaches are, number 1, a range trading approach. So when you're seeing the market trading between support and resistance, you are assuming that the support and resistance levels are going to continue to hold and trading the market as if it's going to stay then within this range. And then number 2 is a breakout approach. So with the market where it is trading between support and resistance, you're looking for signs that perhaps the support or resistance is going to break down, and then you're going to trade as if the market is going to break out from that range. And as we said before, we can further break each of these 2 basic approaches into 2 different methods. So let's look at the first 2 methods for the range trading approach. So the range trading approach can be broken into these 2 methods. Number 1, I've called the bold method, which is more like striking while the iron's hot, quite an adventurous way of range trading. And then the second one I've called vigilant, where it's a little bit more deliberate, a little bit more cautious and wary, looking for some confirmations that the range trading approach is correct. So we'll look at each of these in turn. So the basics of the bold version for range trading are very simple. If you've identified where there is evidence of support and resistance, then those are your potential entry level. So as an example to illustrate this, here we have the market as before rising up to the resistance level, and simply that is where you take your short positions. You sell at the resistance level. The target price then is here at the support level, at the bottom of the range. Now the pros or the advantages of this method really is that it is just so simple. The major risk is, of course, that you are so reliant on the market staying within the range. So even though we are saying it is a bold method, there is still a requirement for some risk management in case the market doesn't stay within the range and it breaks out. So what can we do in terms of risk management? Well, we can use a stop loss. So if we are selling at the resistance level and our target price is the support level, and of course this could be the other way round. You could be opening a position buying at support with a target at the resistance level, but either way your potential profit is this amount Y, which is the distance between the support and the resistance. Now it follows that if our trade goes wrong, we want our loss to be less than our potential profit. And so if we follow that line of thought, then the stop distance should be some fraction of Y. In this example, the stop distance I put here is Y over 2, half the channel range, which means for each trade, your potential loss, which is your risk, is half your potential profit, your reward. Obviously, where you decide to put your stop loss is your trading decision. And now on to the Vigilance Method. Here we aren't simply trading on the blind assumption that support or resistance will hold. Instead, this method seeks to look for a confirmation first that support or resistance has held before entering a trade. So it makes the trade-off of some potential early points of profit in favor of improving your chances of trading when the market actually does remain in a range. So what we're looking for is for the price to actually rebound from the edge of the range. So once you've seen that price rebound, once you're happy that support or resistance has held, resistance in the case of this example, then that's when you enter the market, selling in this case. Once again, your target is the other end of the range. So the target buy price stays in that same point, which is at the support level in this example. Now, the advantage of this method is that, as we said, you're trying to improve your success rate. We're trying to miss out on those instances where resistance or support actually break down when the price just carries on moving through them. But bear in mind, with this more vigilant method, you are entering later in the cycle of each price oscillation. So your potential profit, which is the distance between this sell level and the support level, is actually slightly smaller than the bolder method that we looked at before. Furthermore, of course, that has implications on your stop level. Let's say that this potential profit is Y, as with before. Then if you're putting your stop a fraction of Y away, let's say Y over 2 away, then that is actually much closer to the edge of the range than we looked at before. And just as with our range trading approach, we can split our breakout approach into two different methods. One bold and one more vigilant or cautious. So let's take a look at these. So first of all, the bold version for trading breakouts. Pretty simply, you're trading once you've seen a clear break outside the range. So here the price has risen up towards the resistance level. It hasn't rebounded back into the previous range, hasn't rebounded into that sideways channel. Instead, it's traded higher. You've made a decision that this looks like a clear break through the resistance, and you've entered the market with a buy in the hopes that this break through the resistance results in the market continuing higher and higher and higher. In other words, forming a new trend. Now, what is a clear break? It's a bit of an ambiguous term. Really, what that means would be down to your own trading discretion. Maybe you choose some percentage of this previous range and use that as the amount you want to see it break above. Maybe you use some technical indicator to confirm that there's a breakout going on. But really, the concept at play here is that it hasn't just edged a little bit above. There's a significant enough move to convince you that resistance or support has been decisively broken. Now, what about a target price? Well, ideally, as we said, we're looking for a new trend, in this case, an uptrend, so we don't set a target price. Instead, you're going to try and remain in the direction of the trend if it does form, as long as that trend persists, until there is decisive evidence of an end. Now, the big downside to this breakout approach in general is that you get lots of fake outs. Let's say the market trades below the support here. It actually ends up a lot of the time coming back in, and you don't get a big new trend forming that you're looking for. So you do need to practice some disciplined risk management. And that's why it's such a key point to hold on when a big new trend forms as long as you can, because that big amount of profit you make from that is going to be what outweighs the many times when the market fades you out. And finally, the Vigilance Method for trading breakouts. This method, instead of trading when price first breaks outside the range, instead looks for a further confirmation. And that confirmation looks to the technical analysis axiom that resistance becomes support and vice versa. So in the case of this example, price has moved beyond the resistance level, and then when it has drawn back, it hasn't moved back into the previous range. Instead, resistance has become support, and we get a rebound, and that is our confirmation, and you buy and enter the market at that point. So this method has the advantage of trying to weed out some of those fake outs by looking for that confirmation. The downside, though, is that if you do just get a straight clear breakout, let's say the market dropped through the support level here, you're not seeing that confirmation and you've missed out on the very thing you're looking for. And don't forget, the Trading 212's app comes with a practice mode, so that if you think you might be interested in any of these 4 different ways of trading with support and resistance, you can give it a go without risking any money. Have as many dry runs as you need until you're happy with your own trading decisions. Well, I hope you enjoyed this video looking at 4 different ways to trade with support and resistance. If you did, please just take a moment to hit the thumbs up button and give us a like, or why not share your thoughts with us in the comments section. Which of these 4 methods do you think is the best? Drop us a line. We do read every message we receive there. But that's all for now from me, Peter Martin, and Trading 212. Thanks for watching. I'll see you next time. Goodbye.